IDFC First Bank is in focus. The net interest margins came in at a record high. Retail loans were strong as well. V. Vaidyanathan, the MD and CEO of IDFC First Bank, is joining in. Lata is also here in the studio to take us through that interview. Lata, over to you.
Thank you very much, Sonia. Mr. Vaidyanathan, congratulations to strong advances and deposit growth as well. Retail on both advances and deposits doing very well for you. I'm just playing devil's advocate. Let me start with what worries the street. The margins have risen despite it falling for everyone else. So, there's just a worry. What is your cost of funds and what is the yield on advances that gives you such strong margins?
We discussed this last time, Lata, but I'll repeat
Yes.
it. Our cost of funds this year, this quarter went up to 6.2%. Last time it was 6.1%, went up by about 10 basis points. But at the same time, we dropped our savings rates from 4% to 3% on the 0 to 1 bucket. That also cushioned things a little bit. But overall, we think that these are risk-adjusted margins, and our credit cost continues to be quite strong and stable. So we're really looking forward to expand this model the next 3-4 quarters, and people will see meaningful improvement. I think the concern, if I may put it so, is not so much in the name from what we hear, but people are concerned about the fact that our cost-income ratio did not improve, and our OPEX a little higher.
Okay. No, I am coming to the cost to income, which is high, in fact, gone higher a bit. But before that, the logical doubt is that if you have such high margins, 6.4, that perhaps means that you are, lending to high risk, high return borrowers. And that is also reflected in the fact that your slippages are high. 3%, 3.07% annualized slippages is higher than most good banks.
No, Lata. We went through the same discussion last time. You have a long memory. I don't know why you're forgetting. Same discussion. We spent full 10 minutes on this. Okay. There are three important criteria to measure credit quality, and we are acing all three of them: gross NPA, net NPA, and credit cost. Now, on credit cost front, we are trending at about 1.3%. We guide for 1.5. For this portfolio, for any portfolio, if you even take one of India's best banks, which has been growing at 30% for maybe 25 years for 30 years until slowdown, even their credit cost has been running at about maybe 1.5, 1.6% for a long periods of time. So therefore, 1.5 is a good benchmark. We are going below that benchmark. Our NPA is 1.45%, Lata. Our net NPA is 0.5%. So don't come prejudiced on these numbers. This is the way the model works, and it is behaving well for 14 years. By the way, 14 years is like a Raman's time. So we've just...
no quarrel at all. I began by congratulating you on the fact that many of the ratios are positive. But why are slippages high? Why is it at 3%? And when would you see that fall?
No, Lata, you should see the net slippage, because in the nature of the portfolio, some gross comes, some net comes. As far as our credit cost stays 1.4%,
yes, it
is absolutely fine. You need to get and you meaning, even others who are observing the program, you will get to see this play out over a period of time. So you should see credit cost. Credit cost is what provisions we take, and that is running 1.3. 1.3 is a good number.
Yes. No, I don't deny that. It's just that one worries that is it a high risk, high return kind of design that you have, and whether that
it's
might lead to problems later on.
No, Lata, like 14 is a long time, so please get used to this. And secondly, it is not high risk, high return. You should call it high risk if credit cost was high. If NPA was high, net NPA was high, credit cost was high, nothing is high. How can you call it a high risk model? It's just a specialization. It's a specialization we have, and we should appreciate we are able to lend to a particular segment in a very low risk model with a low credit cost. I think we should get used to this.
Okay. No, I'm sure a lot of people are. Your stock has done very well. I'm just asking you the skeptics question. When you see very high yield on loans, that becomes a logical question. Okay, now let's come to the cost to income. Yeah. Now let's come to the cost to income. Yeah.
Let me clarify, by the way, Lata, that you should. Let me just make it. You should ask your questions so that you feel comfortable.
Okay. Yeah. No, it's important that skeptics out there get your side. Get the rationale as to why, your GNPAs, there are so many metrics on which your asset quality is good, and that needs to come out as well. Cost to income, now 73% is really high. What explains that, and when do you see that coming down? Because that tells on other margins like ROA, etc.
Yes. See, Lata, everybody knows very well that this is a setup stage bank. This is a DFI. Don't forget, this is
Yes.
a DFI converting to a bank. So DFI with a 75,000 crore loan book, you got to replace it. The whole deposits, from bulk deposits, corporate deposits, paying off bonds, everything is being funded by retail money. How does retail money come? Retail money comes when you put up a deposit franchise. How does a deposit franchise? Your branches, ATMs, technology, people, everything is coming up. So this is a setup stage bank. So our thing is very simple, that this is a stage of the bank. When you look forward, even 1 year ahead, just to give you a picture, we feel that things will look better, and the numbers will play out as they come.
Okay. Well, any guidance you can give on where cost to income and ROA may look a year down the line, 2 years down the line?
Let's talk. Say Q3 25 and Q4 25, because that's
Okay.
you can.
Yeah,
It's
fair enough.
in horizon. So we feel that in that window, what next year something important to play out at the bank. We feel that our OPEX as OPEX growth will be just about 20% odd. Traditionally, we've been growing at about 33% because we were setting
Yes.
up. Now it will grow by 20%. We feel that number because we are already originating 50,000 crores a year from our deposit franchise. Since we are slowing down the loan book, it is easy to fund that now. So we feel that next year our deposit will grow by the expense will grow by 20%, income will grow by about 25 odd percent. So by Q3, Q4, you should see meaningful improvement.
Fair point. Yeah, I was going to say that your OPEX per branch is much higher. I mean, about 2-3 times what it is for a Federal or a IndusInd. I mean, I'm not comparing it to the older banks, but yes, okay, your point is that you're just setting it up and that's why it's high.
It's an early stage bank, Lata. We should not forget that.
Yes, it's early stage in some ways and late stage DFI in other ways. You refer to the fact that now that you are lowering your loan growth, is this something that the Reserve Bank has advised? I mean, they're telling all banks to lower their credit deposit ratio. So is that why, even in your investor presentation, I noticed that you have lowered your loan growth target from 24% to 20%. Can you explain that?
We will not change the target for this year. So in the sense that we're already growing at 24.5.
No, the long-term target, yeah.
Exactly. So now we're guiding for the next 5 years to compound only at 20, because yes, we are reading the signals from the marketplace. We're reading the signals from the market, from the regulator, that we should be very careful, and we really want to be careful. For us, our gross NPA of 1.5, net NPA of 0.5, and credit cost of 1.5 is a badge of honor. It's a badge of honor holding for 14 years. So we don't want to let go of it. So therefore, to be a little safe, and for us to be safe and continue this badge of honor is more important. And frankly, whether we go at 20 or 21 or 22, whatever the market affords us, if we can do better, we'll do better. But our intent is to go at that rate.
Fair point, Mr. Vaidyanathan. The questions are, from a skeptic, only because there will be skeptics out there. But many congratulations for a very good number in terms of advances, loans, profits, NII. Many congratulations. Thank you very much.
I want to share one last number before you sign off, Lata, because some viewers may not have this perspective. Of our total expenses, because a cost-to-income ratio is always under the look, of our total expenses, close to about 30% is employee expenses, about a 22%. 22% is what we pay for DSAs and direct marketing agents, etc. That should taper off now because we're originating from the branches. Close to another 22% is pure variable expenses, and close to about 7 or 8% is marketing, etc. Marketing and infrastructure, etc. So this is a broad breakup of our expenses. We feel that we will get to see the leverage play out over the next 5 years. The most important thing, we're guiding for a return on equity improvement by 2025. We're guiding for the following bank. Gross, loan book of about 5 lakh crore, deposit of about 6 lakh crore, and ROE of about 17-18, and ROA of 2%. This is a broad picture people should look forward to. I feel such a bank will be quite, hopefully it'll be well valued.
Look forward, sir. Look forward. Thank you very much indeed for joining us.
Thank you very much.